All right, welcome back, focused learners, to another explainer. Today, we are tearing down a massive pile of fresh data from the 2026 SaaS benchmark reports. We're talking insights drawn straight from heavy hitters like ChartMogul, Pavilion, and KeyBank. And listen, the rules of the game for software as a service, they have fundamentally shifted this year. Seriously, the exact strategies that were building unicorns 5 years ago are literally bankrupting companies today. To actually thrive in this totally new landscape, we need to look really closely at how strategic cohort analysis and hyper-disciplined metrics are separating the absolute winners from the rest of the pack.
Okay, let's dive into this, because the answer to that question is a massive, undeniable yes. The wild era of hypergrowth fueled by cheap, endless venture capital, it's completely dead. I mean, think back to 2020 and 2021. Investors were totally fine tolerating massive cash burns just to watch top-line revenue inflate like a balloon. But as interest rates ticked up and the market matured, a really swift, harsh correction took hold. The entire scoreboard has been rewritten, and the industry has recalibrated around a much stricter, much more demanding standard.
Look at this stark contrast. Back in 2021, founders were practically handed giant checks just for driving raw volume and running a high burn rate. Today, the focus has completely pivoted over to capital efficiency and sustainable unit economics. Now, don't get me wrong, this isn't some sad story about austerity. Top quartile SaaS companies right now, in 2026, are still growing north of 25% annually. But the whole paradigm shift is in how they are growing. Investors now demand disciplined growth. The spotlight has moved away from simply buying up top-line awareness. Instead, it's all about executing highly targeted customer acquisition and, crucially, actually retaining the revenue you already fought so hard to get. So, here is the playbook we're unpacking today. First, the efficiency era. Second, rethinking customer acquisition costs. Third, NRR as the ultimate growth engine. Fourth, defeating churn. And finally, mastering efficiency metrics. Starting right off with Section 1, the efficiency era. Tracking the new normal. So, while the top companies out there are still putting up really impressive numbers, the underlying engine mechanics have completely changed. You can't just look at a rising monthly recurring revenue line anymore and just assume the business is healthy. Actually, the data shows a massive pivot towards strategic cohort analysis. Basically, this means you aren't treating your user base like one giant faceless blob. Instead, you're evaluating retention and efficiency metrics over time by grouping your customers, maybe by the month they signed up, their geography, their industry, or their specific business model. This rigorous cohort analysis lets you see exactly when people are dropping off and which marketing channels actually yield the highest lifetime value. It's essentially how you spot a leaky bucket long before the entire ship goes down. Moving to Section 2, rethinking customer acquisition costs, basically the true price of growth today. Listen to this. Acquiring a new customer has quite literally never been more expensive. Digital ad costs have just skyrocketed. Google Ads alone are up 164% since 2019. Plus, B2B sales cycles have dragged out to a really sluggish average of 134 days. And that brings us to this massive number, $1,200. That is the new median customer acquisition cost for B2B SaaS. Prepare for some major sticker shock here, guys. It now takes the median SaaS company $2 just to acquire $1 of new annual recurring revenue. Think about that. You are spending $2 to get one back. That figure is up 14% just since 2023. If you're out there blindly pouring money into paid ads without a rock-solid conversion funnel, you're burning cash at a completely unsustainable rate. So, how on earth do top-tier companies combat this? Well, the data reveals they treat marketing as a highly scalable system focused on qualified demand, rather than just chasing raw traffic. They are rigorously defining their ideal customer profile based on high buying intent, not just some vague demographic data. They're structuring their SEO around dense topic clusters that establish deep systemic authority, rather than just blindly chasing single keywords. They're also leaning heavily into partnerships, co-marketing, and product integration so they can borrow authority and share audiences. And finally, they are making absolutely sure their marketing data and sales teams are completely aligned on what genuinely makes a qualified lead. No more throwing bad leads over the fence. Okay, Section 3, NRR, the ultimate growth engine, the cardiovascular fitness of your SaaS. Now we shift over to the middle of the funnel, to the metric that truly separates the thriving companies from the ones just clinging to life support, net revenue retention, or NRR. This is the measure of retained and expanded revenue from your existing customers, fully accounting for any upgrades, downgrades, and churn. Think of it kind of like this. If your annual recurring revenue is your company's heartbeat, then NRR is your cardiovascular fitness. So why is this so absolutely crucial in 2026? Because existing customers now generate 40% of all new ARR. Let that sink in. In a slower growth, high-cost environment, expansion revenue is literally the cheapest growth available to you.
Now, what's really interesting about this slide is the massive gap between the average and the elite. You've got the industry median NRR sitting at 106%, which basically means a typical company grows just a tiny bit without adding a single new logo. But then you look at the top quartile, they're pushing 120% and beyond. Enterprise software with strong network effects, they're sustaining NRR of 130% plus. The data completely proves that companies with an NRR over 100% grow 1.5 to 3 times faster than their peers.
Which brings us to Section 4, defeating the silent killer. We have to talk about managing churn. It's time to transition to the dark, ugly side of retention. This quote brilliantly illustrates a really harsh truth about the current market. If your GRR is below 80%, your expansion revenue is just putting a Band-Aid on a gunshot wound. Gross revenue retention, or GRR, measures how well you retain revenue before you even count any of your upsells. And here's the tricky part. A high NRR can actually mask a severe underlying churn problem. Experts are calling this the 100% NRR trap. If your GRR is hovering down below 80%, your product is fundamentally bleeding users out the back door. And those successful upsells to your remaining clients are just masking the bleed. You absolutely have to fix that core retention before you start obsessing over expansion.
Let's move to and see how this builds, because we actually know exactly why these customers are leaving. A staggering 41% of churn happens purely because of a lack of activation within the first 90 days. If your users don't hit their aha moment quickly, they're gone. Simple as that. Number 2, 23% of churn is now tied directly to budget cuts. You have to be proving your ROI constantly. And finally, top quartile companies are heavily utilizing AI-driven proactive customer support. They're detecting usage drop-offs and intervening before the customer even thinks about hitting that cancel button.
Finally, Section 5, mastering capital efficiency metrics. Time to look at the big picture. Zooming out to the macroeconomic view, this brings us to the burn multiple. Because to command those premium valuations today, the whole company has to operate efficiently. This metric is basically just your net cash burned divided by your net new AR over a given period. So, for example, if you burn $5 million in a quarter to add $4 million in new AR, your burn multiple is 1.25x. In 2026, this formula has become the primary shorthand that venture investors use to measure capital discipline. It answers the ultimate bottom-line question: exactly how much is it costing you to grow? So the crucial point is this specific number right here, 1.5x. A burn multiple below 1.5x is the strict target for scale stage performers today. Seriously, if operations run above a 2.5x beyond the seed stage, investors are just going to walk away. No questions asked. The absolute best top quartile companies in the world right now are running highly efficient engines with burn multiples below 1.0x. It's incredible. Let's pull the whole shebang together and summarize the holistic benchmarks you really need to be aiming for across the board. Your lifetime value to CAC ratio needs a minimum floor of 3-to-1, with the top companies hitting 5-to-1. Your CAC payback period? That should ideally be under 12 months. You definitely want to hit the rule of 40, meaning your growth rate plus your profit margin equals 40% or higher. And here's an increasingly vital metric: ARR per employee. The best-in-class, super lean operations are generating $300,000 or more per employee. The data consistently shows that the most successful companies are using strategic cohort analysis to spot the bottlenecks in all of these metrics before they compound and completely drag down efficiency. Which leaves us with this one final, totally critical thought. We've seen today that the scoreboard has completely changed. Capital is no longer free, acquiring customers is staggeringly expensive, and retention, it's the only true path to scalable growth. So look closely at your cohorts, look at your burn multiple, look at your NRR. I challenge you right now. Is your SaaS genuinely built to survive and thrive in the stark reality of 2026? Apply these benchmarks today and build a growth engine that actually lasts. Thanks for learning with us, and we'll catch you in the next explainer.